keywords MCQ series, and today's topic is basis risk management. Basis risk, one of the important risks in treasury risk management. Okay, so follow the video till the end. Firstly, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study materials plus live classes, ebooks, tests, everything. Whatever we need for the clearing CAIIB, you'll be getting it over here. Okay. Let's start with the series. Yesterday's homework. Yesterday I had given you an homework. The yield to maturity of a bond is same as. So YTM is same as what? YTM, yield to maturity, is same as present value of the bond, future value of the bond, bond's internal rate of return, and none of these. So yes, it was YTM is same as what? YTM means what? See here, YTM, yield to maturity, means if I buy the bond today, okay, it's like this. If I buy the bond today I buy the bond, okay, and I keep it up to the maturity, okay, up to the maturity of that bond. If I keep it, let's say it is for 3 years, 1, 2 and 2, and this is third year. If I keep this bond up to the maturity of its, then the returns which I get from this bond, yearly yield which I will be getting from this bond, this yield, when I take it on an annualized pattern, annualized method, means using the future value formula, okay, this yield, annualized return, totaling down, that is known as my total internal return, okay, along with whatever I get at the end also. Okay, so the YTM of a bond is same as bond's internal rate of return, okay, IRR. It is same as IRR. Got it? Move on. Okay, the features of net interest risk are net interest risk. What do you mean by net interest? Net interest means basically NIM, net interest margin. What are we talking of, right? When there are more earning assets than paying liabilities, interest rate may arise. Interest rate risk may arise. This is risk, okay, risk may arise if the market interest adjusts downwards. Means if my assets are more, liabilities are less, and the interest rate falls down, then will it be a risk to me? Or B is what? When there are more earning assets than paying liabilities, interest rate risks may arise if interest rate adjusts upwards, if it goes up. So logic is simple, question is only this. And third one is okay, it will have no impact on the economic value of the bank's asset. So no impact, that is not the right answer. Definitely net interest risk will always affect the bank's overall economic value. So C is out, D is also out. Now what remains? Only A and B. So if assets are more than liabilities, okay, and the interest rate moves up, down, then will I face the problem? Okay, let me explain you. Assets are more than liabilities means what? I am having 100 crores of loans, okay, loans over here, and then I am having, let's say, 50 crores of deposits. These are liabilities. Loans are assets, deposits are liabilities, okay. So 100 crores of loans and 50 crores of deposit. Let's assume both of them have the same rate of interest. Let's say 7% both. Okay. Now what happens? Okay. Or else what we'll do is take a practical view. Let's say it has 9%. Loans have 9%. Deposits have 7%. Now what happens? If the interest rate falls down, okay. Down means what? So on 100 crores, how much am I earning now? I am earning 9 crores, right? 9 crores annually I am earning. And here, how much is going out? 50 crores. 7 5 is 35, right? 7 crores into 7 into 5, 3.5, right? So 3.5 crores is going out. So that is minus for me. And this is 9 crores is plus for me. So how much am I earning? The gap of this. So 5.5 crores I am earning over here. 5.5, okay? Now what happens? The interest rate falls down. Both fall down by the same rate. Let's assume this. Okay, both fall down by, let's say, 1%. So this becomes 8 and this becomes 6. Okay, so 8 into 100, I am earning how much now? 8 crores. Okay, and this becomes what? 6%. Both fall down by 1%. This becomes what? 6%. So 6 5 is 30. 3 crores is going out. Minus. And plus is what? Plus. So what is my net effect? 5 crores. So what is the answer over here? The net interest risk, when there are more assets than paying liabilities, the interest rate risk may arise if the market interest adjusts downwards. So if both of them have gone down, so I am getting more income or less income over here? I am getting lesser income, right? If my interest rate falls down, if I am having more assets, then my overall earning will always be reducing. Okay, so the answer is A over here. Okay, reverse will be the case if my assets are less and liabilities are more. Means if I am having 50 crores of assets, loans and 100 crores of deposits, then if the interest rate moves up, then I'll be in trouble. Everyone got the answer? Got it? Got the clarity first. This is important. So type yes in the comment section if you have understood it. Type yes, everyone. Okay, move on. What are the features of price risk? So what is the price risk basically? Price risk means the price of the bonds. Always remember the rate of interest, ROI. Okay, ROI of the bond. Okay, and the price of the bond, price, both are always inversely related. Okay, asking rate, or we called it yield also. This can be called as YTM also, YTM. Asking rate, there are many names to this. So if this moves up, the price of the bond will move downwards. Always remember this. Okay, so you want to see this present situation. Present situation, just check the bond rates from October 22. I'll write it over here. October 22 to December 22. Okay, just check it for these 3 months and you'll see the difference. The interest rates were rising heavily because of that Russia-Ukraine. Right now also it's there, but at that time it was at the peak. Okay, so the bond rates were rising high, and that's why the prices of the bonds were falling down. Okay, so coming back, what are the features of the price risk? When the assets are sold after their maturities, it may result in the price risk. Means if I am holding some bonds with me, I am holding means somebody else has sold it to me, and I am holding. It's like the FD. Some bank has given me that FD. I am holding that FD with me, but I am selling it after the maturity. Means I am going to the bank after the maturity, 2 months after the maturity. So is it a price risk, or will it result in the price risk? Now forget FD, think about the bond, same logic. So will it result in the price risk, or the price risk is not associated with bank's trading volume? Price risk is not associated with bank's trading volume. So it does not depend at all on my trading volume, price risk. If my trading volume is more, will my risk be more or less or no relation? So obviously it will be more. So this can also be the answer. This cannot be the answer. Not associated. If this would have been associated, then this would have been the feature. So B can be the B will not be the answer. What about C? Bank may create such trading investments out of short-term movements in the interest rates. So bank may create such trading investments out of short-term movements. Okay. So now the problem is only between A and C. When the assets are sold after the maturities, it may result in price risk. What do you say? Whether it's A or C, what should be the answer? Forget D, because B is out, so D is out, right? So give me the answer, A or C. Everyone, yeah? Right? Got it? Yeah. See this. A is not the answer. Why A can't be the answer? Because assets are sold after their maturities. Means it's an operational risk. It's not a price risk. Operational. Some of your employee or your system has not worked properly. This system should have triggered that this is the maturity of the bond today. Kindly sell it to that concerned company. Okay. So this should have been triggered. So this is an operations risk. This is not a feature of price risk. Okay. So the only answer is C. Bank may create such trading investments out of short-term movements in the interest rates. So price risk will also give rise to the earning part of the bank also. If the prices of the bonds go down, the bank may grab these opportunities and get the bonds right now in their favor. Okay, so they'll buy the bonds at that time. So when the interest rates later fall down and prices move up, bank will sell it, earning the profit. So answer is C over here. Understand the concept of price risk. Okay, next one. Which of the following statements is not correct? Remember, not. Okay, the bond prices and the yields are directly related. What did I say just now? Bond prices and the yields means asking rate. They are directly or indirectly related. Everyone. Just now I gave you that example, right? They are indirectly. So this is not correct. In fact, we want that only not correct. So the answer is itself in A. But what about B? See here. You have got this answer of A. But what about B? Just give me the logic behind B. Market risk may apply to pricing risk for the assets held in the trading book. We want not correct. Now what is trading book? Okay, give me the answer. How many books are there in banks, in treasury? How many books are there in treasury? Everyone. How many books are there in treasury? Everyone. Fast. How many books are there in treasury? There are 2 books. Which are those 2 books? Everyone. One is this trading book. And second is banking book. Okay, these are the 2 books. Banking book. Remember these 2 books, banking and trading. Banking is for statutory reserves. Mainly CRR, SLR, all the compulsory reserves are kept in banking book. Okay. What about the trading book? Trading book is for the proprietary person. Proprietary means earning profits. If my bank is here, after all I am a bank, I have to earn profits. Then only I can run. So earning profits is done in trading book. Okay. So this is correct, but we want not correct. So the answer B is out. What about C? See here, you have got the answer A, but we are in CAIIB. Not only remember getting the answer is correct, you must understand the logic also. What about C? The market risk may also apply to foreign currency risk. Means market risk may apply to foreign currency. So is it true? Does market risk apply to foreign currency? Yes or no? Yes or no? Yes, that is correct. Why? Because have you seen the dollar rates? One dollar equals to, sometimes it is what, 80. Then after 6 months you see it has gone to 84. After 6 months you see it has gone to what, 90 or sometimes 75. Right? So what is it? This is the risk. If I bought this dollar for 80, okay, and it goes down to 75, then I am at risk, isn't it? So the market risk may also apply to foreign currency risk. So that is a true part, but we don't want true, we want false. So the answer is only one. The bond prices and the yields are directly related. The correct answer for this is the bond prices and the yields are indirectly related. Remember, indirectly. Got it, everyone? Clear the concept? Yeah. Okay. What is not a forex risk? Not a forex risk. Now think, here, you all read this now. I'll give you 2 minutes. You all read this and let me check how many of you can answer right now. Okay? Read this. Everyone. Yeah? Everyone. Yes. What is the answer you're getting? What is the answer? Yeah? Say this. The risk which may arise due to favorable exchange rate movement is called forex risk. We want not. So we want false answer. We don't want true answer. Okay? Risk which may arise due to favorable exchange rate movement is called forex risk. See here. Forex risk arises when the rates move in the unfavorable situation, unfavorable direction. Means, I'll give you a simple example. The earlier example, I bought the dollars, $1 I had bought it for 80. Now if the dollar goes to 75, so that is unfavorable for me, right? So this is known as unfavorable and this will lead to forex risk. So we want false. The risk may arise due to favorable exchange rate movements in the forex risk. So this is false statement. So the what we want, which is not the forex risk. So is this a forex risk? Due to favorable exchange rate, is this a forex risk? No. So this is the answer. Again the same point has come, means you have got the answer in the first A only. What about B and C? You can definitely skip B and C and move out now. But right now we are in the study session. So I'll read B also and C also. This occurs on account of open T plus 2, right? Transaction plus 2 days. Forward means T plus 2 and above, means about 2. You can call it T plus 3 and above, isn't it? What are the other markets? Okay, one is spot, second is forward. What about the remaining two? How many of you can tell me the remaining two? What are the remaining two markets in forex? Everyone, fast. They are cash, correct? Cash, and second is Tom. Tom is transaction plus 1. Cash is T plus 0 today only. Okay, got it? Okay. So this occurs on account of open position in spot and forward market. So that is true, but we want false. So this is not the answer for what we require. It is applicable to individual foreign currency. So forex risk is applicable to individual foreign currency. It is true, because it is applicable to any forex currency. This forex risk will be applicable. So this is true. See here, I'll write here. This is true. This is also true. This is false. And what do we want? We want the false answer. So that's why these two can't be the answers. Okay, A is the answer. Got it? Now, one for your homework. The counterparty risk is, what is the counterparty risk? Counterparty risk means it arises due to non-performance of trading partners when counterparty may refuse to perform. Now this is for your homework. I won't answer it now. It is treated as a transient financial risk. Transient. Okay, understand the meaning. Tomorrow I'll answer everything about this, but today you will have to search it yourself. It is more associated with trading. Is it associated with trading? This or no? You search, and D is all of these. So tomorrow I'll give you the answer for this. Okay. So in the meantime, firstly, these are the two new batches. March 24th starting. Okay. Join these batches ASAP. We are covering all the 4 subjects: ABM, BFM, ABFM, BRBL plus elective. Okay. 80% discount is going on. Double validity on Mahapacks. What is the Mahapack? 15 plus batches per subject. ABM 15, BFM 15, ABFM and BRBL 15. Okay. Electives also you get the recorded videos, so you can definitely clear elective also. Okay. So join these batches ASAP, because these are the selection batches, long batches. We discuss everything in details. How to get the discount? Use the code Y432. How to use this code Y432? Okay, let me show you. Let's go live to Adda 24/7. If you are having the app, I would suggest go on the app. Okay, because in the app you will be getting 1% extra. Okay, let's go to the Adda 24/7. Let me show you. Okay, see here. Now we are on the site Adda 24/7. Okay, click on this. See this. In the front page itself, you'll see CAIIB and CAIIB. Click on CAIIB and CAIIB. Once you click on this, you'll see this CAIIB 23. Click on CAIIB 23. You'll see the batches. Look at these. Okay. CAIIBs. Click on this English batch, March 24th starting. Okay. You'll see the details. What are the details? Date. When is it starting? What are the days in the week? Then what are the timings? Then what all features do you get? See here, in this batch mainly I'll give you recorded videos are available 24/7. So it means you can, even if you miss out on any class, you can definitely get back to that class. Okay. Also two-way interactive classes. Two-way interactive means you can ask the questions there and then itself and clarify doubts. Ebooks are available. Tests are available. Test means here per subject you are getting the test. So it's very simple in the exam. Okay. That's why join the batches ASAP. Subjects are new. Remember this. Okay. Okay. What is the fees? 23,999. Click on view offers. Check the offers first. Always check the offers. Put the code Y432. What is the code I told you? Y432. Never forget this code. Click on apply. Look at this. 23,999 reduces to 4799.80. 80% off you are getting. Such a huge discount you are getting, man. What is this? It's an investment for lifetime. Okay? Okay. One more thing I'll tell you. Joining this batch, or you should join, I would say, Mahapack. What is Mahapack? Just now I told you about Mahapack. Mahapack means what? 15 plus batches. How to join that? See this. Go to JIB CIB Mahapack. Click on this. See this. You will see the details. JIB ka Mahapack, CIB ka Mahapack. Click on CIB ka Mahapack. Okay. Then you will see the details again over here. 15 plus batches for ABM, BFM, ABFM, BRBL. 15 plus batches for, this is CIB ka Mahapack. Okay. 15 plus full length mock test. Topic wise question bank, ebooks. Okay. So these are all our, of course, recorded videos are available. Now look at the fees part. Okay. On the fees part, click on this. See this. 35,996. Click on view offers. Put the code Y432. Click on apply. Now look at this. 35,996 reduces to 7,199. 80% off. My God, 80% off you are getting. Such a huge discount. And that also for what? Lifetime investment. 15 plus batches you are getting in this 7,199. Per subject you are getting 15 plus batches. And validity is 6 plus 6 months, 12 months. If you divide this 7,200 roughly by 6 plus 6 months, 12 months, it will come to what? 12. So 600. If you divide that by days, it comes to 20 rupees. So 20 rupees per day. Yeah, and divide this by batches again. So it's more, hardly 1 or 2 rupees per batch, 1.5 rupees per batch. It's an investment for lifetime. Go for it. Such offers you don't get it again and again. Okay. So I'll close over here. Tomorrow I'll be back with another session. Till then, keep studying, and always again I'll tell you, join the batches. Such offers don't